Every week, two stocks hit new highs for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. This week's 52-week highs were dominated by tech and financials. Chips are still booming, with ASML, Applied Materials, and Intel all breaking out. There was also strength in mining, energy, and industrials. In short, the market is showing broad strength no matter what the doom and gloom crowd is saying. But inside that long list, two names stood out for what they say about the real economy: Dollar General and Dollar Tree. These were disaster stocks last year. Depressed earnings, huge theft issues, and awful store conditions. Now they're breaking out. So today, we're looking at these $2 store giants to answer one big question. Is the lower income consumer finally not screwed? And what does that mean for the broader economy? Let's see what Dollar General is telling us about the lower income consumer. Dollar General is one of the biggest discount chains in the US with nearly 20,000 stores. It's long been the go-to for lower income consumers. Watching Dollar General gives us a window into everyday consumer behavior and how shoppers are coping with rising prices. But it's not just low-income consumers anymore. Higher-income shoppers are trading down and coming in too. Dollar General's ready for them with an updated pricing strategy. The store isn't just an everything's cheap place anymore. About 20% of the items are $1 or less, but the rest are higher priced. Carefully structured so the store still feels like a bargain. They're also preparing for this shift by renovating stores. They've heard customer complaints about poor quality and are working to fix it. They're not stopping there though. They're also building an online strategy, adding 1-hour delivery and finding ways to monetize customer data. Next, let's dig into Dollar General's earnings to see how effective these efforts have been. Dollar General's recent earnings paint a picture of a company under pressure. Q3 2025's net sales hit $10.6 billion, up 4.6% from last year. That sounds okay until you compare it to their long-term annual growth of 8%. Even more concerning though, trailing net income is down 4.4% year over year compared to an average net income growth of nearly 12%. That's what's got investors spooked. The story looks a little better than the lows, but the financials don't show a clear turnaround. Margins are still under strain. EBITDA margins are down to 7.5%, compared to a historical range of around 10%. Net income margins are just 3%, far below the company's typical performance. The company is growing, but it's nothing like the glory days. This pressure is exactly why Dollar General is investing in new ideas like the DG Media Network. By monetizing customer data through targeted advertising, they aim to add a high-margin revenue stream that could help restore old margins. Delivery is another bright spot, and modernizing the business could bring in higher-income consumers that will boost margins further. The narrative is one of recovery, and the market seems to like that story. But the financials are still catching up. When it comes to valuation, Dollar General isn't cheap. The stock trades at a forward PE of about 19.3, slightly above its historical average. That's not extreme, but it's high given the pressure on margins and slower top-line growth. Based on their current trajectory, I'd estimate around 5% net income growth. Add in the yield from buybacks and dividends, and you're looking at roughly 10% total annual return. If the forward PE holds steady, that translates to about 61% growth over 5 years. That underperforms the broader market. To get an attractive return, the forward PE would need to re-rate closer to 11. At today's multiple, growth is too low. If the PE contracts to that level after buying now, investors could see roughly negative 8% total return over 5 years. That's not a risk I'd take. Bottom line, unless Dollar General shows meaningful growth or the stock trades at a lower PE, this is a hard pass. The biggest risk with Dollar General is the forward PE dropping. Without meaningful net income growth, investors could sell the stock down. Right now, the price is largely driven by the story. DG Media, and delivery. That's also the upside though. If these strategies succeed, they could push Dollar General to new heights. There's a clear lesson in Dollar General. Narratives can move stocks faster than fundamentals. Growth stories like DG Media or delivery excite investors, but always make sure the story lines up with the numbers. Next, let's take a look at Dollar Tree and see what it reveals about the struggling consumer. Dollar Tree has entered a new era. After spinning off Family Dollar in 2025, the company is fully focused on its core Dollar Tree stores. That focus lets them pour energy and capital into improving the brand, the stores, and the customer experience. The biggest change is the shift to a multi-price model. The strict $1 rule is gone. Items can now sell for $1.25, $1.50, $3, $5, whatever. This lets them offer higher demand items, larger sizes, and better quality products, all while still keeping deep value for shoppers. The goal is simple. Keep the value, add variety and discovery. Even with a small dip in traffic, Dollar Tree grew revenue by raising prices and selling higher value items. This approach is also bringing in higher income shoppers while still keeping their core, budget-conscious customers engaged. In short, Dollar Tree wants to be a store where everyone feels like they're finding a deal. A cheap goods store that competes on both price and selection. Now, let's dive into the earnings and see how this strategy is showing up in the numbers. It's actually hard to read Dollar Tree's financials right now thanks to the Family Dollar spinoff. But one thing is clear, margins have improved a lot, and that tells us Family Dollar was dragging the business down. Personally, I'd want to see a few more quarters to know what revenue growth really looks like. Right now, though, let's focus on what management is saying they're going to do. We'll check back in the future to see if it ever shows up in the numbers and if they were successful. First, the multi-price model is interesting. It lets them sell higher priced items that people probably would have bought anyway. Halloween was a big win. Multi-price items brought in a lot of extra profit. If this keeps up, it could push revenue above the usual dollar store trend. Second, they're buying back shares aggressively. 8% of outstanding stock. That's huge. And after the Family Dollar fiasco, I don't want them taking big risks with profits. Just return it to shareholders. Third, the company knows the stores need work. They've seen the headlines, they've heard the complaints, and they're putting money into fixing them. So far, the moves make sense. They're focused on profitable growth, getting cash back to shareholders, and improving the customer experience. Now, the real question is, how do we value all this uncertainty? Valuing Dollar Tree right now is rough. We just don't have a clear picture of future growth. I have low confidence in any forecast we do, but let's be conservative and assume 5% annual net income growth. Funny enough, the 4 PE is about the same as Dollar General's, 19.3. At that multiple, that gives us roughly 10% total annual return when you include share buybacks. If the forward PE stays the same, that works out to about a 61% return over 5 years, underperforming the broader market. The main risk? The multiple could drop to 11, which would make returns negative. Here's the interesting part though. This quarter, growth hit 9%, way above Dollar General's 4.6% and a jump above our conservative 5% estimate. If the company can sustain that extra 4 points, we're looking at a roughly 93% return over 5 years, beating the market. But I'll pass. A 93% market beating return isn't worth the risk of a negative 8% return if the forward PE contracts or growth doesn't materialize. Especially since Dollar Tree only delivered about an 8% total return over the last 5 years. Instead of the usual what could go wrong risks, let's look at one that actually happened. The failed Family Dollar acquisition. Profits got tied up there, and investors didn't see returns. It's a clear reminder that profits don't automatically turn into gains for shareholders. If management doesn't return cash through buybacks or dividends, and instead reinvests poorly, you can lose out. That's why I've been cautious with companies like Copart, which have massive cash piles. The takeaway? Management's plans aren't guaranteed to work. Profits don't automatically turn into returns. Cash can be a huge advantage if used wisely, but it can also be spent poorly, causing massive losses. So what do we take away from these $2 stores? Dollar General shows us how narratives like the DG Media Network and delivery can create excitement before the numbers actually catch up. Dollar Tree is a bit different though. They're experimenting with the multiprice model, aggressive buybacks, and store improvements. But we also see a critical lesson. Management misfires can sink returns. Profits don't automatically turn into shareholder gains. These companies are more than just investment lessons though. They give insight into the economy and consumer behavior. First, shoppers are under pressure, but they're still spending. Second, higher income consumers are trading down, which could be a sign of economic stress or shifting priorities. Third, companies are increasingly trying to monetize every part of the customer experience, like we saw with DG Media. If they can collect data on you, they'll find a way to profit from it. These weren't great investments right now, but watching companies like Dollar General and Dollar Tree helps you understand what consumers are doing and where the economy is headed. If you found this helpful, hit like. And since you stuck around this long, join me on Discord. Link in the description. I'm a real person, I promise. Thanks. Bye.